Good morning, students. Welcome back to the session on audit. So today we first of all plan to continue with our discussion on SA 260. That was about communication with those charged with governance. I'll just do a quick recap and then we'll also look at practical example and then we'll move on to our next auditing standard. SA 260 basically deals with the interaction or having a communication channel between the auditor and the board of directors or the audit committee. That is about those charged with governance primarily. Now, in respect of this communication, what is the flow of communication? Means what's the frequency? How should this communication really happen? So this is not specifically prescribed. So that this depends on the auditor. So whether auditor wants to have a discussion in person or whether wants to have a discussion by writing to them, or whether the auditor would like to have discussion with them every quarter, or in case of a unlisted company, whether the auditor would like to have a discussion with them, say less than by maybe having meeting which is not really equivalent to this 4 meetings in a year, which generally happens in case of a listed company, and that is again the minimum number. Next aspect was about the points or the agenda which the auditor would always want to have a discussion on with the audit committee or with the board of directors. Now, as regards those points, first of all, auditor would talk about his independence, his role, that is about his scope, his responsibilities, and what has been the procedures which the auditor has planned around execution of those responsibilities. Next thing which the auditor would want to specify would be in respect of the significant matters. So if there have been any significant matters, all those significant matters would also be communicated by the auditor to the audit committee. If there are any misstatements which may be forming part of the audit report, if there are any misstatements which are not forming part of the audit report, but those are not material and those are forming part of the representation letter, those will also come over there. If there have been any audit adjustments, those will also come over there. If there have been any specific representations, those will also be communicated to the audit committee, because it's the audit committee who has appointed the auditor, who has brought this auditor on board, and that's why it's something which the which we can say is a kind of support which the auditor provides to the audit committee or to the board of directors or to the management in terms of ensuring that the financial reporting process is working in a fine manner and the financial statements are giving a true and fair view, and that is something which is expected out of the auditor to check whether that has been happening or not. Correct? Yeah. So this was all about this auditing standard. So now let's move on to one example or one situation, and let's try to understand how should the auditor really deal with that situation. So let's suppose there has been a discussion in respect of a client with the management in respect of the audit of the financial statements of a company. So auditor has discussed all the matters with the management. So the discussion with the management is already done. Okay. Now the next point is the discussion with the audit committee. So that's the next step. Now, in respect of this discussion with the audit committee, which the auditor plans to do, auditor is also discussing those points with the management, that this is what I want to carry forward, or this is something which I want to carry to the audit committee in terms of the discussion with them. Therein, some of the points which the auditor wants to discuss include, one is CAM. So auditor wants to discuss key audit matters, which include revenue recognition, and second is inventory valuation. Yeah, so these are the two agenda points with which management is also okay. Next, auditor wants to discuss misstatements which arose during the course of the audit. Whether those were rectified or not, auditor wants to carry all of them. Okay. Plus, auditor would also want to have a discussion on this representation letter, wherein the management has refused to provide a specific representation in respect of these two matters because these are forming part of CAM. Okay. So management is saying representation will be given for all except for these two. Why? Because these are forming part of CAM. Now, as regards this entire discussion which the auditor has done with the management, now we need to just understand as to how these should really be dealt in terms of the audit by the auditor, and how should this really be communicated by the auditor to the audit committee. Okay, so once again, we can just try to create certain situations. How should these matters be dealt? First situations. So we can say option number A, that as regards this rep letter, this should be communicated. Okay, this should be communicated to the audit committee that there is no representation in respect of these 2 points, but CAM is something which should not go. CAM should not go to the audit committee, because if we are covering that in the form of the ref letter, then there is no point having separate discussion on this. And third, misstatements. Misstatements should also not be going there, because if these misstatements have already been adjusted in the financial statements, then there is no point having a discussion with the audit committee in respect of those misstatements, because anyways those are not material misstatements in totality. So this is option number 1. Yeah, let's look at option number 2. Option number 2 could be the situation wherein the rep letter is discussed, communicated to the audit committee. CAM is also discussed, communicated to the audit committee, but misstatements are not discussed with the audit committee. So this is option number 2. Option number 3. Option number 3 could be in respect of a situation wherein CAM is discussed, because that anyways is very, very important for a discussion with the senior management, with the audit committee, etc. So this should be discussed. This should be communicated to the audit committee that these have been the matters which were significant during the course of the audit, which took some time and which were critical for the understanding of the audit committee. And misstatements should also be going there, because if these are adjustments, whether those have been made or not, then of course audit committee needs to know, because management didn't do this right, and this was the auditor who had to get this corrected, with which management was absolutely fine, but still it's about auditor telling the audit committee that this is something which I got corrected. Yeah, so sorry, so this should be communicated, but rep letter is something which is more of a documentation. A rep letter is more of a documentation. So there's no point having a discussion around this documentation with the audit committee. So this should not really go to the audit committee. Okay, this is option number C. Option number D. Option number D could be a situation wherein all these points, CAM, misstatements and rep letter are communicated to the audit committee, and as regards these misstatements, only the one which are significant in terms of amount, may not be material. So I'm just telling significant means if those have been very, very small items, then auditor can skip that. And of course, auditor should not really spend time on those misstatements in terms of its discussion with the audit committee. So only the significant one should be discussed with the audit committee or communicated to the audit committee. But of course, other 2 points are also important. So there are 4 views which are possible. And if you want to attempt this, please let me know. So out of these 4 options, which option would you as an auditor want to consider? What are your thoughts on any of these options? Yes. We will also move on to the solution then. Okay, so I have this response from Sumit. Sumit is saying CAM should always be discussed with the audit committee first. Okay, so this is one. Then I think this is a query from Ambika. Ambika is saying, does the auditor need to communicate his responsibilities in relation to audit of financial statements, even though auditor's responsibilities included in the engagement letter? Of course, yes. So in terms of the audit responsibilities, it's all about the scope which the auditor would communicate and the planned timing around that. So that is always communicated, irrespective of the engagement letter. This will always be communicated. In fact, let's suppose if every quarter there is a meeting, so every quarter this will be communicated, because every quarter there could be a separate discussion which the auditor may be doing with the audit committee. Ambika is saying that Ambika would like to go with option number D. Okay, so then we can move on to our solution and we can just analyze all of these options one by one. See, as regards this rep letter, of course, this appears to be important. And when it comes to the rep letter, then one may definitely argue that what is the point of having discussion on all the points of the representation with the audit committee, because we also discussed that it's about the key matters or it's about the key representations which can be passed on to the audit committee and not all the matters. But unfortunately, in this situation, management has refused to give the representation on these 2 matters. And that's why this discussion of representation letter, wherein these 2 representations are missing, becomes important on the part of the auditor, because this may also have a reporting obligation on the part of the auditor. So that's why we would say communication of rep letter is important. Yeah, and the moment we say that this is important, then of course our option C goes off. So that means this option is not possible. Yeah, because this excludes the requirement of rep letter. Number 1. Number 2, as regards CAM. Now CAM, we have discussed that CAM is all about significant matters. So if the significant matters are not communicated, then what else will be communicated to the audit committee? Because this is of extreme importance. And anyways, when we'll talk about CAM, you'll also understand that CAM forms part of the audit report now. So if something is forming part of the audit report, then definitely that should be communicated to the audit committee. And I'm getting this response from Anjali that it should be option number D. Okay, let's see. So that means option number A is not possible, because this doesn't require CAM to be communicated to the audit committee. And we can move on to option number B now, because B requires CAM to be communicated and rep letter to be communicated. So this appears to be correct so far. But moving on to the third point, that is about misstatements. Now, as around misstatements, misstatements could be numerous. There could be so many misstatements during the course of the audit, which auditor may not like and which auditor may not want to have a discussion with audit committee on. Why? Because those have been numerous. Secondly, those may not be very significant. And when I say significant, again, I'm not saying those are crossing the materiality threshold, because if those are crossing the materiality threshold, then auditor will definitely discuss those with the management. But at times, there could be certain misstatements which are less than the materiality, but still those are of significant value. And because all of these corrections reflect weaknesses in the internal control of the entity. Weaknesses because otherwise these adjustment entries should have been passed by the management itself, and these were not passed by the management itself, and that's why these are sort of weaknesses. Correct? Yeah. And that is why to say that misstatement should not be communicated at all will not be correct. Yeah. So that's why this option also goes away. And what would be the right option? Option number D, that all of these three should be communicated. Okay. Clear, all of you? Yeah. And you got this answer also right, that this is option number D. So now we can move further. Now we can move further on to the discussion in relation to audit committee only, but with a different perspective, and that is about SA 265. SA 265 is once again in respect of communication with those charged with governance, but it talks about communicating deficiencies in the internal control. So let's see what is the requirement of this standard and what is this internal control deficiency which is required to be communicated by the auditor to the management. So I'll just move on to the next presentation now. Okay, so first of all, we can look at some of the definitions for getting some understanding, because we have not really spent too much time on all of these deficiencies, etc. Now we are talking about internal control deficiencies. Though you would have covered internal control earlier also as part of your discussions or your understanding related to auditing standards, but still I'll touch upon this internal control. Internal control, we can say, is about a process or is about having a system in place through which activities of the organization work in a manner which is desired by the management, or you can say which is desired by the owners of the company. Let's suppose objective of the organization is to have some procedures in place, means a particular activity should work as per certain procedures. Yeah. Now, if some activity has to be run as per the set policies and procedures, then some mechanism is required to build. That mechanism, or we can say a process, and which will have to be implemented by all, which will have to be followed by all. All means all the employees of the organization, all the personnel who are attached to that organization. Only then such a procedure will function in a desired manner. These type of processes or procedures, or you can say set of activities which have to run in a manner that they result in the so that they come out with the output which is expected out of the which is expected by the management or the senior management, is something we can say is a kind of control established by the management. So that means it's an internal control by the management. It's not something which is an internal control by the auditor. So auditor doesn't set up any controls. Auditor only reviews the controls which are set up by the management. Clear? There are separate there are separate auditing standards which deal with these requirements of internal controls. They also help us to understand how should this internal control be established. What should be the various areas through which this internal control really function? What are those critical areas over which the management should be focusing on in terms of the internal controls? Now, as regards those internal controls, we are not having a discussion whether it's about setup of an internal control or whether it's about implementation of that internal control. Now we are talking about a stage when the auditor has already reviewed those internal controls, and during the course of his audit, means during the course of his audit of the financial statements, when he reviewed the work, he reviewed various areas. He also went through the internal controls of the company. Therein, he found certain deficiencies in the internal control, and that's why now those deficiencies are also getting communicated to those charged with governance. Why? One, this is the responsibility of the auditor, because auditor is also required to issue a separate report in respect of internal controls of the company, which will have an impact on the financial statements of the company. And this separate reporting by the auditor is again prescribed. Yeah, it's not mandatory for all the companies, but there are certain companies which cross a threshold and which is required to be reported there, which is very commonly known as report on IFC. Secondly, whether auditor is required to issue a separate report on IFC, still for the purposes, so let's suppose if still there is a situation wherein the auditor is not required to have a separate report on internal financial controls of the company, even at that place, auditor would be following the internal controls of the company. Why? Because if the internal controls of the company would be strong, then they would provide additional comfort to the auditor. During the course of his audit, there are a lot of activities which the auditor will have to go through. There are various procedures which he'll have to consider. And during the course of his procedures, if the auditor finds some comfort in the internal controls of the company, then he will be able to cut down on his audit procedures, because he will be able to place reliance on those policies, procedures, on those internal controls. Why? Because he would have tested those internal controls, and he would know that all of these internal controls are working in an effective manner, and that's why he may decide to cut down on his audit procedures. So that's why it's a very, very critical area on the part of the auditor anyways, means whether it's getting reported in the form of a separate audit report or not. Now, as around this point, once the audit is completed and the auditor has come across certain deficiencies, therein auditor will have to decide that out of those deficiencies which are there in the control, which all deficiencies he would like to communicate with those charged with governance. Okay, yeah. So let's understand deficiency in internal control. So this exists when a control is designed, implemented, or operated in such a way that it is unable to prevent or detect and correct misstatements in the financial statements on a timely basis. That means control is designed, implemented, and it's also operating, but it's not operating effectively. Or there is a control which is required, it's a necessity. Why? Again, so that it can detect and correct the misstatement in the financial statements, but that control is missing altogether. So both the situations are possible. Maybe the management has not established the internal controls, implemented the internal controls, or maybe the internal controls have been implemented, but those are not operating effectively. So both the types of situations, auditor will have to assess, because during the course of his audit, he will get to know about all of these sort of deficiencies. So both these type of deficiencies, he will have to decide. And then comes the point related to significant deficiency in internal control, and this is something which is similar to all other points that we discussed, that auditor will not have a communication around each and every point with the management, with those charged with the governance, because each and every point he would be discussing with the management, and management is there to discuss all of these points. As around his discussion with those charged with governance, he would want to reserve the matters which are significant for the audit committee. And that's why, once again, in respect of these internal control deficiencies, auditor will have to decide which all deficiencies are significant and which all are not so significant. Okay, so let's understand this significant deficiency. A deficiency or a combination of deficiencies in internal control that, in the auditor's professional judgment, is of sufficient importance to merit the attention of those charged with governance. Means he should not take up each and every matter to the audit committee. He should really focus on the critical matters to be communicated to the audit committee. Yeah. Now, what is required on the part of the auditor? Now, required is very simple thing, that all of these deficiencies which the auditor believes are significant should get communicated to the audit committee. And let's try to understand, with the help of few examples, what can be those deficiencies. Okay. Say, for example, auditor tested revenue, and when the revenue was tested, auditor found controls were missing in relation to recognition of revenue. Now, in relation to recognition of revenue, we can say there are two situations. One is that sales should not have been recognized. Why? Because they didn't meet the criteria of the accounting standard. So that is an accounting problem, number one. Secondly, sales didn't take place at all. Yeah, sales didn't occur, but still those have been recorded by the management. So that is again a kind of error. Yeah, both the situations reflect lack of control, or we can say lack of effective controls which should have been put by the auditor. And if both of them are missing, then the auditor would decide that these controls in respect of revenue recognition, which either are missing or are not operating effectively, are they significant? And how will the auditor decide that those are significant? Auditor will decide those are significant by looking at the impact which is possible because those internal controls are missing, or maybe those internal controls are not operating effectively. And for this, auditor will generally look at the alternate procedures. See, during the course of the audit, whenever auditor will come across deficiencies, auditor will come across misstatements, auditor would also want to perform some more procedures, so that if something is lacking, auditor can get a complete understanding around that area, so that something significant doesn't go missing. Yeah. And on the basis of the additional procedures and at times alternate procedures, auditor will give himself more comfort in terms of the audit which he would have performed. If the auditor becomes comfortable with the additional procedures or with the alternate procedures, then he would be good to go, because he would know that, of course, that this procedure didn't really help him in terms of forming his view, or those were reflecting certain problems, but with additional procedures he was more comfortable. Now, if auditor is in such a situation wherein he believes that the deficiencies were there, but still there are some alternate controls by the management, or there are some more things which he has looked at and through which he became comfortable, then the auditor may want to drop these points, and auditor may not want to discuss all of these deficiencies with those charged with governance, because they are like the top management, and who would really want to focus on the key areas or the critical areas, and some of these small matters may not really require their attention. But it's very important to have a discussion with the management on those points, and it is done. But there could be certain matters which may reflect serious deficiencies, or we can say significant deficiencies, and whose impact would be very, very significant. Say, for example, if the controls are not in place at all for the payroll function. So an entity has the payroll function, but there are no controls in place. So whichever area in respect of payroll process auditor is verifying, he is finding that the controls are not operating effectively. Now that's a big risk. That's a big risk. Plus, the auditor also understands that company has a policy of having good internal controls, and those internal controls should be operating effectively. Okay, that's the policy of the company. Now, if that is the policy of the company and that has not been operating effectively, this may really impact the functioning of such a department, and this may also have a bearing on the financial statements. Why? Because payroll is something which gets recorded in the financial statements, and there are chances of more errors when the controls are not in place the way those are desired by the management, and more importantly, when the company has a policy. So that means the top management understands the need for those controls and has also required maybe the middle management or the management of the company to have all of these things in place, but those are missing. Therein, the auditor may want to take up this matter to the audit. Number one. Another example. This could be in relation to certain areas which the auditor tested, but he found material misstatements over there. And all of these material misstatements also are moving to the audit report of the auditor in terms of qualification. So if something is forming part of the audit report as a qualification, this may also reflect deficiencies in the internal control related to financial statement closing process. So there's a process once again. What process is that? Financial statement closing process, which is very commonly called as FSCP. Financial statement closing process includes the activities related to the preparation and the presentation of the financial statements as per the requirements of the accounting standards or the Companies Act, or whichever requirements are applicable to that particular company or the entity. Now, if these are not followed, once again, auditor would want to have a communication with the audit committee in respect of those matters. Yeah. Now, coming to this auditing standard, I would say it's more of a continuation of the auditing standard which we discussed. This auditing standard deals with communication with those charged with governance, and the other auditing standard, SA 260, which we discussed, that also deals with communication with those charged with governance. Now, a question may come to your mind that are these two communications separate? So why do we have the separate auditing standard? Or is the timing of this communication same, or will the timing change? So what you actually see is that all of these guidances, even though they happen to be in the form of these two separate auditing standards, those are all same in terms of communication to the audit committee. And similar to what we have discussed in SA 260, same thing will be done in case of SA 265 also. Means once again, a flow of communication has to be established. So there has to be a proper communication channel, and all of these things will be rooted in the same manner what we have discussed in that SA 260. And when it comes to, let's suppose, having a meeting with the audit committee, wherein some of those points which we discussed in case of SA 260 are getting discussed, therein all of these matters will also be discussed. However, at times, management may have a focus on improving the internal controls. Yeah. And this generally comes from companies who look at good corporate governance. At times it is possible. And therein, they may want to have a separate discussion only on internal controls of the company. So practically it happens. Many a times, companies are focused on improvement of their internal controls. And that's why they may not have, they may not want to have a common meeting wherein all the agenda points will be discussed, because the time may not be so much with the audit committee to have a discussion with the auditor wherein all the points will be covered. So that's why they may want to have a separate discussion with the auditor in respect of all of these matters, wherein auditor can tell the audit committee or communicate to the audit committee about all of these deficiencies or all of these recommendations which the auditor would want to provide as to how all of these internal controls can be improved by the company. So at times that is also possible, but as regards the communication channel, that all remains same. Within the audit committee meeting, all of these agenda points will be discussed, including the deficiencies in respect of internal control. And this also happens to be a responsibility of the auditor, as we have discussed, wherein the auditor is required to issue a separate audit report. And in terms of the audit procedures, we have discussed that control testing also forms part of one of the areas of the auditor. And because control testing is required and control testing is getting done, so that will also throw up certain deficiencies in most of the cases. Okay, yeah, clear? So we can look at a couple of points now. The auditor shall include in written communication of significant deficiencies in internal control. So what does he include? A description of the deficiencies and the explanation of their potential effects. Potential effects will arise wherein the auditor don't see any potential, wherein the auditor didn't see any impact, but may expect that such a problem may lead to some impact in the future. Yeah, because if the deficiency is there and if the deficiency is significant, then even though impact is not arising today, it may arise in future periods. Number one. Secondly, sufficient information to enable those charged with governance and the management to understand the context of communication, in particular the explanation that purpose of audit was for the purpose of expressing an opinion on the financial statements. Audit included consideration of controls which are relevant to the preparation of the financial statements, but not for the purposes of expressing an opinion on the effectiveness of internal controls, and matters being reported are limited to those deficiencies that the auditor has identified during the course of his audit and the auditor has concluded are of sufficient importance to merit being reported to those charged with governance. Because once again, if we look at the audit will also have its limitations. See, audit is also performed on a test check basis. Audit doesn't mean that we are going to check each and everything, isn't it? Because the auditor will not be checking each and everything. It's something which will be happening on a test check basis. So that's why auditor will also have to bring out those aspects which he would have covered in his audit of the financial statement. So that's why this proper communication by the auditor to the management becomes important, wherein he would communicate that all of these things which he has been communicating, this has been identified during the course of audit of financial statements. So he's not doing a separate review altogether of the internal controls, because that was not really his scope. His scope was to provide an opinion on the financial statements, and during the course of the procedures related to that scope, he was able to identify these points which he's bringing to the knowledge of the audit committee, because he believed those points to be significant enough for the purposes of their understanding. All right, clear on this? So with this, we come to an end to our discussion related to deficiencies in the internal control which are required to be reported by the auditor to the audit committee or the board of directors. Yeah, okay. So now what we can do is we can move on to next auditing standard, very important one, I understand, and that is on SA 240. Before that, I can see some queries coming in. Let me just move on to those queries, please. Ambika is asking, can it be taken as SA 260 controls related to financial reporting process is communicated? I'm not very clear on your query. Is it that you, so I'm not very clear. Maybe you can just elaborate in this. I'm just assuming that you are asking that can we make it a part of SA 260 itself? If that is the point, then essays are not required to be specified in the communication document. Means, let's suppose if there is a presentation which the auditor is making to the audit committee, so he'll not be giving the reference of the essays. So we are not really bothered that whether it is arising out of SA 260 or SA 265 or any other auditing standard. Huh? So it's all about communication of all of these points which are going to the audit committee. So you should not really worry that which auditing standard this is coming out of when it is getting communicated to the audit committee. Then Jay has a query. Jay is saying, how is the CAM identified and what's the difference between CAM and rep letter? See, actually, as around CAM and rep letter, we have separate auditing standards, and we are going to have a discussion on both of them. So I would just park the understanding of CAM and rep letter for some period of time till the time we don't take up those auditing standards. But just to give you an overview, CAM, you can just understand, is all about key audit matters, or you can say significant audit matters which were experienced by the auditor during the course of his audit. And rep letter is about a representation which the management gives to the auditor in respect of preparation of the financial statements, means how the management prepared the financial statements. So that representation is given by the management to the auditor. Yeah, so there's a big difference between these two, and these two are completely different topics. Okay, clear on this briefly? But as I told you, we'll have a separate discussion on this. Then Sumit is asking, communication of internal deficiencies to the management is the responsibility of the internal auditor. Definitely. See, if the company will have an internal audit, then communication of deficiencies, and when it comes to deficiencies, I'm assuming you are talking about deficiencies related to internal controls. Then of course, the role of internal auditor is to support the management as well as those charged with governance. Internal audit is also a separate function, independent function, which is involved in all of these activities, and they definitely have this responsibility. All right. And that also depends on the scope of the internal audit. And we are also going to have a separate discussion on internal audit, but slightly later, please. Okay, so then we can move on to the next topic. SA 240. SA 240 is about auditor's responsibility in relation to fraud in an audit of financial statements. And before we move on to this aspect related to fraud, we can just have a discussion around these points which you can see on the screen. Yeah. Let me just first of all take you to the scope of the audit and the, you can say, the responsibility of the audit. See, as part of audit, auditor is required to express an opinion that the financial statements give true and fair view. Correct? Yeah. So let's understand. So auditor is looking at true and fair view in respect of financial statements. Okay. And because it's true and fair view, so that's why what will the auditor want to check? That there are no material misstatements. Okay. If the misstatements are there, it's okay, but the misstatement should not be material. Material means significant. For the time being, you can just say it's about having significant misstatements. Now, what is a misstatement? Misstatement basically is an error. Very simply, to put it, what do we call a misstatement as? An error. Now, this error can be intentional or unintentional. If that is unintentional, what do we call it as? Mistake or error. But if that is intentional, then we may not really want to call it as an error or a mistake. We may want to just, emphasize on this point, and this may not be really coming out of this common terms or this, sort of not so heavy terms of error or mistake. We may want to call it by a different name at times, and that is fraud. So what is fraud? Fraud is all about mistakes or the errors in the financial statements and which are intentional. Now, when it comes to intentional, means these have been done intentionally by the management of the company, by the employees of the company, by those charged with governance. So we are not saying that who has done this intentionally, but for sure, fraud would reflect a situation which is intentional, because fraud is not something which will happen unintentionally. Yeah. Now, what is the role of the auditor? The role of the auditor is to ensure that misstatements should not be material. So if there are misstatements, it's okay, but those should not be material, because if those are material, then it will become a problem for the auditor. And that's why for these material misstatements, how will the auditor look at these type of misstatements into the one which are errors, or we can say which are unintentional, and the ones which are intentional, which are in the nature of fraud. Okay. And to take care of these misstatements, or to make sure that none of the misstatements go unidentified, what would the auditor want? Auditor would want evidence, which is called as audit evidence. Correct? How would the auditor get the audit evidence? Through his audit procedures. So he would perform various audit procedures, and through those audit procedures, he would be able to get the audit evidence. Now, this audit evidence should be sufficient and appropriate. Okay, now what is sufficient? Once again, I'm just touching on these points briefly. What is sufficient? What is appropriate? It's about quantity as well as quality. Means the quality of the evidence should be good, and the quantity should be the one which is desired. Means it should be the correct quantity. Once we have this sufficient, appropriate audit evidence, through the audit procedures, then we can say that the material misstatements would get identified, whether those are resulting through something which is unintentional, or whether those are resulting through something which is intentional. Okay, yeah. Now, in respect of audit of financial statements, when all of these procedures are getting performed, and when the auditor would be looking at sufficient, appropriate audit evidence, one of the areas on which auditor is required to focus includes fraud. Fraud, we can say, is a very, very significant item, and an item on which auditor has to focus on. So let's understand the meaning of fraud. What is fraud? An intentional act by one or more individuals amongst the management, those charged with governance, employees, third parties, involving the use of deception to obtain unjust or illegal advantage. Okay, yeah. Fraud could arise through any of these persons. One thing which is very critical in respect of fraud is that this is intentional in nature. And that's why to detect fraud at times may become very, very difficult on the part of the auditor. Secondly, when it comes to the fraud, we are actually looking at a situation wherein controls may be missing or controls are there, but those are not operating effectively. Yes or no? Because if there is something in the nature of a misstatement taking place within the organization, then only two situations are possible. Either the control is not there or control is not operating effectively. Secondly, because the management has the responsibility of implementing, operating the internal controls. And if the management itself wants to commit fraud, then they would know the ways as to how to manipulate the things. And in such a situation, it may become very, very difficult on the part of the auditor to come to such type of fraudulent activities by the management. Yes or no? Yeah. Because if the management is itself involved, so they would know the ways, they would know the controls which they would have set up and which they now want to just sort of breach or just want to bypass. And they may want to do this in such a manner that auditor is not able to come across those activities which the management would have done in relation to committing the fraud. Now, when it comes to the fraud assessment, or you can say finding the fraud, it's not the responsibility of the auditor. So let us just first of all understand what is the responsibility of the auditor. See, auditor is not there to detect fraud. No. Because if the fraud is taking place, that is coming out because of lack of internal controls. To ensure that there are good internal controls, there are internal controls operating effectively, no fraud is taking place. If the fraud is taking place, to detect the frauds is the responsibility of the management or those charged with governance. It's not the responsibility of the auditor. But because any fraud may have a material impact on the financial statements, that's why during the course of his audit procedures, auditor would also design his procedures in such a way that he is able to cover up the risk of material misstatement arising due to fraud. Okay, so let us first of all be clear in terms of what is expected out of the auditor. Yeah, clear? So once again, it's not the detection which he's trying to achieve. It's about his normal audit procedures he will plan, and during the course of his normal audit procedures, he will also plan procedures to ensure that the misstatements due to the fraud are also taken care of by him. Yeah. Now, as around the fraud, there are certain specific things which the auditor need to take care. First of all, it will be the planning. Now, everything goes on to the planning. As we have discussed, audit is all about planning. So that's why in respect of fraud, once again, planning will become important. So what we can do is, once again, we can just move on to those stages of audit and just try to understand through those stages, how should this really be planned by the auditor and what are those activities which you would want to include in all of those stages. So let's see how will the auditor approach in respect of fraud. When it comes to planning, there could be a situation that the audit of the financial statements of a company which the auditor is doing or planning to start for the current year may have some documentation in relation to the fraud which may have taken place in the past years in respect of that company. Yeah. So that's why whenever auditor would be planning his work, he would be making sure that in the past years, whether there was any fraud or not. And this is something which will come out of his documentation. So he would be using his experience, we can say. Or I can say he's using his past experience of that client. He would be using his past experience of that client. Because when the auditor will have a planning meeting with the audit team, they would be discussing that in the past, in the last year, some of these type of activities took place. Secondly, auditor would be having risk assessment. That is again, which will form part of planning by the auditor. Now, when the auditor would be doing the risk assessment, during the course of risk assessment, various areas are assessed by the auditor. What are those areas which may have significant risks? And what are those areas which may not be significant? Okay, which may not have significant risks. Correct? Now, when it comes to the risk assessment, there again, the auditor will have to focus on fraud. Auditor will have to give a separate thought about the fraud or the activities or the processes or of the organization wherein fraud may occur. So we are not saying fraud has occurred, may occur. So auditor is like he has to be attentive. He has to take care of that type of risk also. Because when it comes to the fraud which may arise, this will always become a significant risk. Yeah. So that's why one type of risk that the auditor will be focusing on will be the risk of fraud. So within significant risks, I would say one of the risks which would be covered by the auditor will be the fraud risk. Now, how will the auditor do this? This is something which will require additional procedures on the part of the auditor, because as we have discussed, that this is not common to everything. This is intentional, and because this is intentional, so that's why auditor will have to do something more as against what he would have been doing for any other activity. Yeah. So let's understand all the things which the auditor would be doing. One, he would be having discussions with the management. Okay. So the same thing will come over here. He would have discussions with the management. That will come over here also. Secondly, he would have an understanding about the risk, about the risks and the internal controls of the company or the entity. See, when it comes to the fraud risk, it's not something which only auditor has understood or auditor is worried about. Management may also have thought about it. That what are the situations, what are the processes wherein any fraud may be possible, and how the management has taken care of those situations. Means what are those controls which the management has implemented in respect of all of those risks related to fraud. So that again will be understood by the auditor on the basis of his discussions with the management. So that means he will have documentation from the management which will help the auditor to design his procedures related to the fraud. Clear? Yeah. Next, auditor would use his knowledge, as we have discussed, in respect of past years. So he would know that there are certain departments wherein the controls are not operating effectively. There are certain areas wherein misstatements are generally significant. So every year when the auditor goes, he finds that the accounting entries have not been passed correctly and auditor is required to get it done. Now those could be intentional also. Yeah. And that's why auditor would have to look at his past years working papers, past years significant matters, and if there is a history of problems in the past areas, that will also be very, very critical for the auditor to analyze. Yeah. Next, in respect of such type of fraud, internal audit function of the management can also help the auditor to a great extent, because this function of the management or this department of the management, or maybe if this team is external to the company, this would have performed their work. They would also have come up with something in terms of their report. So that's why to have a discussion with this department, to understand what are the controls, to understand if there has been any problem during the year which is under audit, will help the auditor. Yeah. So auditor will also have discussions with this department. Correct. Next, those charged with governance. Now, as around fraud risk areas, auditor would want to have a discussion with those charged with governance. Auditor would want to have inquiries from them. Auditor may want to have a discussions with the directors of the company as around some of these procedures, as around some of these activities, as around some of the areas which they believe could be subject to risks, and as to how they would have taken care of those risks. So auditor may want to have a one-on-one communications with the directors of the company, and that is something which you normally get to see in case of some of the large engagements or medium engagements, because in case of small engagements, generally the interaction with the senior management only, because this will also help the auditor in getting to know of the critical areas or the critical processes which the management believes or which the TCWG believes are critical or which may become subject to the problem areas. Correct? Yeah. So this was about consideration of certain points which the auditor would be looking at during the course of his planning. Now, in respect of this, we can just look at another aspect. When it comes to audit of the financial statements, certain areas are always considered to be very risky in nature. Why? Because of the nature of those processes. One of them happens to be revenue recognition, and another one happens to be management override of controls. Yeah. So these two areas in particular will be reviewed by the auditor. And let's see, now we will have a discussion on both of these items one by one. What is the meaning of these two areas and what is it that the auditor would want to achieve out of in respect of fraud risk factors. See, in case of most of the organizations, we see revenue recognition to be a significant risk. Be it any organization, it would generally want to show a good top line because revenues indicate how good a company has been operating. In case of a listed company, for example, they would always be inclined to show more revenues because this reflects very positively about the company. If the company will have significant amount of revenue, if the company will have a revenue chart which is increasing period on period. And that's why this area or this process is considered to be critical, is considered to be the one having significant risk. And this is one area wherein fraud may also become possible. We are not saying that the fraud would always occur. So we are only talking about the situations wherein the fraud may occur. It may or may not occur. Yeah. But the auditor has to be taking care of any situation wherein he believes that the fraud may arise. And this is one of the areas which the auditor would always want to keep as his fraud risk factor. And that's why he would have to increase his audit procedures in respect of revenue recognition. Now, when it comes to revenue recognition or when it comes to any other audit procedure or any of the items, auditor would look at various assertions. Assertions, I'm sure you would be knowing about assertions. What is an assertion? Assertion is all about, you can say, a perspective from which procedure is performed. Say in case of revenue recognition, management may want to prepone their revenues. Means revenue of next year or next financial year may get booked in the current year. And this may be intentional. This may be intentionally done by the management. So that is once again what? That is once again a fraud. That is fraud related to preparation of the financial statements. Correct? And why will that be done? So that the company will have more revenues. Yeah. Similarly, if we look at the revenue recognition, company may want to show revenue by bringing certain transactions which may not have taken place at all. And if the company has been showing those transactions as revenue, then once again there is a risk. Yeah. So in the first instance, we discussed about cutoff. Means the revenues of the next year are preponed to current year, and the transactions which didn't occur at all, transactions which didn't occur at all have been recorded in the financial statements. So that is once again a risk related to the revenue recognition. And both these type of risks are what? Risks resulting from fraud. Correct? Now, because of these risks, what has happened? Because of these risks, financial statements have got impacted. And the financial reporting has got impacted. And that's why we can also say that some of these examples that we have just discussed are in relation to fraudulent, financial reporting. Means the financial reporting has got frauds. And what is financial reporting? Financial reporting is all about presentation of the financial statements. So we can see that impact in the financial statements due to this. Correct? Now, revenue recognition is one area we discussed. And some of the assertions in relation to revenue we have discussed. And you may have a question, is it about only these assertions which are getting impacted, or which are subject to risk, or which are susceptible to fraud? No, it can be any other. These are only examples that we have discussed, and that's why auditor will have to just take care of every situation. So auditor will have to look at every assertion. And it's not necessary that when it comes to the fraud risk factors, then auditor will be looking at this complete revenue recognition as a whole. No, it may happen that auditor is only worried with cutoff. So maybe all other aspects of revenue recognition are fine, but only the cutoff seems to be a problem, because in the past years, auditor may have seen these problems happening in the company. And this is again a very, very common problems with the companies. Because at the year end, they would always want to inflate their revenues. They would want to show higher revenues. So one of the very easy things for them is to just prepone their sales, or just, sort of book the sales of the next years in the current year itself. Because the sales are all actual. It's about the timing which has been impacted, and because of which the revenues are shown higher. Correct? Clear on this? Number one. Next is about management override of controls. This is, I would say, one of the most important areas of audit. And the biggest problem is that this is one area on which there is least focus of the auditor. And this is something which I am telling you on the basis of the experiences practically, that this area is generally not taken care of by the auditors. And that's why there could be a huge risk in respect of audit of the financial statements. And as I told you, this is one of the most important areas of audit. So if this is not done, let's suppose for any reason, then we can just challenge the very purpose of audit of the financial statements. Means the overall audit which has been done may get challenged. So let's try to understand what we mean by override of controls by the management. See, as we discussed, that all of these controls which have been put in place, which have been implemented, and which are required to be operating effectively, they are within the hands of employees of the company to a certain extent. And they are in the hands of senior management of the company to a great extent. Correct? So that's why if the senior management of the company, if the employees of the company themselves want to commit a fraud, then they may do that easily. It's not very difficult for them to do this. They may do this very, very easily. And the biggest problem is that when such a fraud is committed by the employees of the company, and particularly the senior management of the company, their detection by the auditor would become all the more difficult. It becomes very, very difficult on the part of the auditor to catch those frauds, because the management knows everything inside out. They know how to breach something. They know how to breach the process. They know how to breach the control. Yeah. So this area talks about override of controls by the management itself. So this area is considered once again to be what? Fraud risk factor, on which auditor will have to design special audit procedures, because we know that this is critical and we know that this is difficult at the same time. Yeah. So for this, let's try to understand what are those audit procedures which the auditor may plan to do. Yeah. First of all, a very common procedure to take care of management override of controls is called as JE testing, or we can say testing of journal entries of the company. Now, what are journal entries of the company? So let's try to understand this concept of journal entries, because once again you may be thinking, but sir, all the entries of the company are journal entries only. So herein we are not talking about all the journal entries or the general entries of the company. We are talking about entries of the company, or the entries or the accounting entries which have been passed through JVs. See, in the normal course, we will not find a JV to be passed. JV is something which is a kind of intervention by the management or intervention by the employees, and which is again something which is not done on a routine basis, and which is again something which is not done in the normal course of business, or which is not something usually done. Yeah. So that's why something which is unusual, something which is infrequent, something which is not happening in the normal course of the business is required to be picked up by the auditor and reviewed by the auditor, so that he can look at those transactions and he can look at those accounting entries as to what was the reason of passing them. So we are looking at unusual accounting entries. Which are not frequently done, something which is not routinely done. Okay. And let's try to understand about this as to why this would be done. See, every entity will have a process, and the process will also include process of passing accounting entries. But if we see something unusual over there, then this may be something which could be susceptible to fraud. Because why is that unusual thing happening? There is a risk involved in that. We are not saying that will always be an error, but definitely there is a risk in that. So that's why auditor should look at all of those unusual transactions, all of those unusual accounting entries which are passed, which are not routinely done. By doing this, what will the auditor achieve? By doing this, auditor will be able to come across some part of those situations wherein the override may have been done by the management. Correct? Yeah. Secondly, in respect of management override, another thing which the auditor would want to do would again be the inquiries or discussions with the management. Inquiries or discussions with the management to understand and to find out if there have been any problems in the company, if there have been any problems in the processes. Yeah. Number 3, which the auditor may want to do, could be to pick up certain patterns. Now let's see that when it comes to the JE testing, yeah, very commonly this is called as JE testing. How would this really be picked up? And let's look at certain examples. See, when it comes to passing of the accounting entry, and when it comes to a company which remains operational from Monday to Friday. So the normal office working hours of the company are 10 to 6, Monday to Friday. So effectively, we should see that the accounting entries are passed on Monday to Friday. Correct? But if the accounting entries are getting passed for such a company on Saturdays or Sundays, then once again, this could be the one which may have risk of fraud. So that's why what should the auditor do? Auditor should pick up those entries and review them. Because what was the need of passing an accounting entry on the weekends? And therein you may have a thought. You may say, but sir, most of the things when it comes to the accounting is done on weekend only. So even if the working hours are Monday to Friday, accounting teams are working on weekend only. Weekend means Saturdays only. So even though officially the working hours or the timings or the days of the company happen to be Monday to Friday, but we see that every Saturday accounts team comes to the office and they pass the accounting entries, then we may just ignore Saturday. But Sunday is not very common, so we may include Sunday. Yeah, or we may just look at some samples out of them, because this is something which is again unusual. Number 1. Number 2, normally for any organization, we will see that there is an authority matrix. What's the authority matrix? Maybe in an organization, executive, senior executive or manager, say up to the manager level, are required to pass the accounting entries. So they will make the accounting entries, and senior manager and above, say senior manager, then the departmental head, and then the CFO, they will review the accounting entries. So let's suppose that is how process has been established. But there are certain accounting entries which have been passed by the CFO itself. which have been passed by the senior manager and not the manager. So now once again, this appears to be unusual. What was the need of doing this? Why they were required to pass the accounting entries, or why they breached this process of getting this accounting entry passed through a junior, which can then be reviewed by them. So this may also indicate some risks related to the fraud. So that's why another parameter which the auditor could pick up could be the filtration of the accounting entries, say which are passed by senior manager and above. Correct? Yeah. All those accounting entries which are passed by senior manager and above. So this may also reflect some problem. Yes or no? Yeah. Now these are only the examples that I've been discussing with you. Similar to this, there could be various other situations which the auditor may come across or which the auditor may find unusual. Now, all of these things will be dependent on the understanding of the auditor about the processes of the organization. So that's why a very good understanding of the processes of the organization is very important on the part of the auditor, because only then he will be able to design such audit procedures. Yes or no? So if the auditor will not be having the understanding of all of these things, will he be able to design these audit procedures? No. Will he be able to design his audit procedures effectively? No. Okay. Clear on this? Yeah. So that's why it becomes important on his part to take care of these situations. All right. Clear to all of you? Yeah. Now this was another area, that is management override of control, wherein auditor focuses on one aspect, that is related to fraud risk factor. Yeah, and these two areas for any organization we always see being considered as fraud risk factor. So this may or may not result in fraud though. Number one. Yeah. Now, before we move further on this auditing standard, let me just come to some queries which have come from you. So Sumit is asking, sir, does it mean vouching and verification? Means, does this testing means vouching and verification? Of course, yes. So this would mean vouching, verification, looking at the supporting documents, first of all, reviewing the accounting entries, and then getting onto the supporting documents, and then to understand why these accounting entries were passed. Okay, and if there are any problems, to have discussions with the management personnel also. Anjali is asking, sir, if the management is able to give a satisfactory statement, but there may be intentional fraud which may be concealed by the management, what is the responsibility of the auditor in that case? See, if the fraud is committed and that is detected, then irrespective of the explanation, auditor will have to look at the reporting implications, and we'll discuss about all of them also. But if the fraud is committed, auditor has not been able to detect that, auditor has been going through some of these documentation or some of these procedures and he's finding everything to be satisfactory, then nothing beyond this is required on the part of the auditor. As I told you, detection of fraud is not the responsibility of the auditor. But yes, to perform his audit procedures appropriately, to ensure that he carried out his work in a diligent manner, he used his professional experience, his professional judgment to ensure that the audit evidence which he obtained was sufficient, appropriate, is very important. Yeah, so that should not get missed. Then I think Anjali had a query I missed out. So Anjali is asking, sir, if there is a situation that the company has recorded sales on 31st of March and returns, and those sales got returned on 2nd of April, high probability that sales may not have occurred. That's true. What is the responsibility of auditor in this case? So auditor needs to first of all understand as to what is the amount of those sales returns, whether that is significant enough, and why is that sale return taking place, and accordingly make the adjustments in the financial statement. Because if those sales returns have taken place, so better to get the revenue reversed in the current financial year itself, because there is something which has already happened. So there's no point recognizing revenue to that extent. Okay. Yeah. And the management will also have to concur with that. Clear? Yeah. So now I'll not move further on this. What we can do is we can now take a break of 10 minutes. So after the break, we will continue with our discussion in relation to this auditing standard, and we'll also look at some more examples. Yeah. Clear? In the meantime, if you have any query, you can just feel free to send your query. And after the break, we'll start with your queries and then with the remaining part of the auditing standard. Hi. So we can now continue with our discussion related to this essay. So we are talking about certain situations wherein this fraud may arise in relation to the financial statements. Now, during the course of this discussion, we have touched upon one point which is related to fraudulent financial reporting. Now, we can say that the fraud which may occur and which may have an impact on the financial statements could again be broken into two parts. One aspect that we have discussed about the fraudulent financial reporting, when we see that revenue has not been recorded appropriately. So it's all about making some intentional mistakes in the books of accounts. And intentional mistakes could not really be limited to the revenue. It could go beyond revenue. Say, for example, overbooking of expenses, intentionally done by the management. That is again a fraud. Okay. Other than this, another type of fraud which may occur in a company could be about misappropriation of assets. Now, what is misappropriation of assets? Let's suppose there's a cash embezzlement by the cashier. Maybe the assets of the company, maybe the physical assets of the company have been stolen. Yeah, these are all what? These are all misappropriation of assets, and those are also fraudulent factors which the auditor needs to take care of. And once again, in respect of all of these points, whether this fraud can take place or not will again be on the basis of understanding of the processes of the company. Because wherever the process will be weak, therein the chances of fraud will increase. And wherever the controls will be stronger, and the controls will be such that the involvement of many persons is there, then the chances of fraud goes down. But at the same time, collusion is possible. That maybe the senior management, middle management, they have all come together and in a joint manner they want to commit this fraud. Yeah, so that is again possible, and that is again something which can be done by the management. So auditor will have to take care of all of these situations during the course of his audit to ensure that such type of risks do not really impact the financial statements, or if they are impacting the financial statements, those are appropriately adjusted in the financial statements itself. All right, clear on this? Now moving further, in relation to all of these things which may arise during the course of the audit, let's see if there is a fraud. Okay, let's suppose if there's a fraud which has actually occurred during the course of the audit, or say during the course of the financial year, and which has become known to the auditor. Maybe the management itself detected the fraud, or maybe the auditor detected the fraud. Now, what are the responsibilities on the part of the auditor? So what should be the communication on the part of the auditor in relation to any of the fraud which gets detected? One, auditor would need to discuss all of those details about the fraud and the impact of that fraud with the management first of all, because it's the management with which auditor will have been dealing on a day-to-day basis. So auditor will have to discuss with the management. Secondly, auditor will also need to communicate those things to those charged with governance. Even though management would have communicated that, or it's presumed that the management would have communicated, still it will be the responsibility of the auditor to communicate those matters to those charged with governance, because these matters will always be the significant matters for the purposes of the auditor. These cannot be considered not to be significant. Correct? Yeah. Then depending on certain threshold as to whether the fraud amount is less than 1 crore or more than 1 crore, certain more reporting obligations may arise on the part of the auditor as per the requirements of the Companies Act, which can be picked up by us later. That is another one aspect which arises on the part of the auditor to have these reporting requirements. Another area, or we can say another form of the audit report, requires mandatory communication of such type of frauds in the audit report itself. And that audit report is again very commonly known to all of you, and that is called as CARO. Companies Auditors Report Order. And I'm talking about this CARO old one, not the CARO 2021, because 2021 is not applicable to all of you. So this CARO has a separate requirement wherein any fraud which is committed on the company or any fraud which is committed by the company is required to be reported by the auditor. So auditor, whether he wants to report such type of matter or wants to bring out any such matter in the form of say having some material impact in the main audit report or not, but still auditor will have to report such matter in the CARO. Let's understand about a fraud which may not be significant enough, okay, which may have an impact, which may not misstatement the financial statement. So that means it may not be material, and that is something which the auditor assessed, and auditor has performed procedures around it. So auditor has formed a view that he will not report about such matter in his main audit report, but still such matter would come to CARO. Why? Because fraud anyways is a significant matter which may not have impacted the financial statements materially, and that's why it may not have gone to the audit report, but it will not be considered to be not so significant that it may be ignored from CARO itself. So from CARO, it should be reported. Correct? Clear on this? Yeah. At times, other than this, there could also be certain obligations which may arise due to various regulatory requirements on the part of the auditor to report about any such matters to the regulatory authorities. For example, in case of certain entities or companies which are subject to RBI regulations, there could be certain reporting obligations on the part of the auditor to report such matters to certain regulatory authorities. So wherever such regulatory requirement exists, therein the auditor will have to follow those regulatory requirements and make the communications accordingly. Therein he cannot skip that. He will have to necessarily report that. In addition to what he would be doing internally. Internally means those charged with governance or means the one which is bringing out in his audit report, be it CARO or the main audit report. Clear? Next aspect about the audit which the auditor will have to consider is the strong documentation. So this is one point which we will discuss everywhere in the audit. See, this is one area wherein auditor will not be able to later on prove that he has done his job diligently, he has performed his procedures appropriately if the fraud gets detected and the auditor doesn't have the documentation. Yeah, and the auditor may get stuck badly on that. So that's why it's very, very important to have a strong documentation. Strong means robust documentation wherein the auditor brings out his scope clearly, brings out his procedures clearly, and brings out all the aspects which he would have considered clearly in respect of designing the audit procedure, so that tomorrow when he gets challenged, tomorrow when he's questioned about the audit procedures which he should have performed but he didn't perform, so that the fraud which may get detected later on could have been detected by the auditor, and let's suppose the onus of that fraud is later on passed on to the auditor, so he should be able to protect himself, and that is only possible when he will have the strong documentation available with him. So that's why, once again, the documentation of the working papers, documentation of all the audit procedures in respect of all of these things is very, very important. And that's where what we have seen practically is that this is one area which is taken lightly. And this is one area on which the focus is not there. But this happens to be one of the most critical areas in respect of fraud risk factor. So that's why this area needs strong documentation again. And strong documentation is only possible when the procedures will be performed on that. Okay, clear? Next, in respect of all of these transactions, or in case there is any fraud or any fraud risk event which might have taken place, once again, auditor will need representations from the management. So the representations will have to come from the management itself. Yeah. So this will also form part of representation if there are any misstatements which are not material, but which have arisen due to any of the frauds, that will again form part of the representation letter which will flow from the management to the auditor. Clear? Yeah. So what we can do now is we can just look at one example around this. And all of you need to attend this case. Okay, so let's talk about a company wherein the audit has been going on for say financial year 2019-20. So the audit is going on for financial year 19-20, and auditor has come across a couple of situations. One is in respect of overbooking of expenses. Number one, overbooking of expenses related to various items. Say overbooking of expenses related to we can say salaries, overbooking of expenses say related to admin expenses. Yeah. Now this is something which has come to the knowledge of the auditor. Auditor has been able to detect this during the course of his procedures. He found that the appropriate documentation was not available with the management for booking these expenses. Yeah. So this is one. Secondly, one fraud also occurred and for which employee of the company was responsible. Okay, let's suppose this was related to cash. So cash has been taken away and the amount, let's suppose is say rupees 1 lakh. So let's suppose this is another fraud. Yeah. We can say size of the company is big enough, wherein 1 lakh cash is not a very significant amount. Company, let's suppose, has a total asset size of say 400 crores. This is the size of the total assets, and their revenues are also significant. Let's suppose their revenue during the year was approximately 250 crores. So this is the size of the company. Okay. Let's suppose auditor was working at a materiality level. Say for example, materiality level or the materiality threshold of the auditor was rupees 40 lakhs. So this is the materiality threshold of the auditor. Correct. Now in this situation, we are required to assess and comment how should the auditor deal with this. How should the auditor deal with this? In this situation, what should the auditor do? Whether it's about overbooking of expenses or about this flow related to the cash. Number one, when it comes to overbooking of expenses, we can say that the amount has been significant and for which adjustment has also been made. So this has been adjusted in the books. Management agreed and adjusted. And for this fraud also, adjustment has been made in the books. Okay, yeah. Now tell me, on the basis of certain options that we can discuss, what should really happen on this? First, this matter number 1 and matter number 2 should be communicating to those charged with governance, and those should be brought to the main report. Okay, yeah, those should be brought to the main report. Option number A. Option number B. 1 and 2 should be communicated to those charged with governance. These should also be communicated to ROC. ROC means the registrar of the companies, that means MCA. And third is that these should also form part of the main report and CARO. They should go to both the reports. CARO is applicable on the company now, considering the size. Option number C. 1 and 2, because these are adjusted and because these are not significant. See, look at the materiality level, and these were also not crossing the materiality level on an individual basis. On an individual basis, they were not crossing the materiality. So that's why they should not go to those charged with governance. Those should not go to those charged with governance, but yes, they are required to be communicated to the regulatory authority. It's mandatory obligation on the part of the auditor. Okay. Number 4. These matters should go to those charged with governance. These should be communicated to them, and they should go to CARO. Matters should go to CARO, but these matters may not get reported in main report on the basis of the assessment of the auditor. Clear? Yeah. So let's understand out of these 4 options, which one is better. So I can see a couple of queries coming in. I'll just come to this. Before that, if you can just answer this question. And I think one of the query before this will be relevant. Sumit is asking, sir, why CARO is there? Why is it necessary? Auditor can report in its audit report. So what is the need of CARO? So CARO is an addition, or you can say is sort of an additional part of the audit report itself. Yeah, along with the audit report, CARO is also required to be commented upon by the auditor, and that's the need of the CARO. And for CARO, I'm sure you would have gone through the details from CARO at inter-level also, but anyways, we'll also be discussing a lot of points around CARO during the course of our various sessions. Secondly, as around the CARO requires a specific reporting on this point, and that's why there's a need for mandatory reporting under CARO. Okay. Now, let's come back to this question, please, quickly, all of you. Ambika is saying, sir, option number D. So Ambika is going with this option number D. So let's understand. When we say that this matter should be communicated to audit committee or the board of directors, is that important? Of course, yes. That is important. So that's why any option which says that it should not go to them will not be correct. Secondly, whether it should go to main report or not will depend on its materiality, will depend on its significance. It's not a necessity that because there was a fraud, so that's why it has to go to the audit report. No. So that's why this first option is not correct. And then to say that the reporting has to be done to the MCA, did we talk about it? No. And sorry, in the meantime, Ambika has changed the option. So Ambika has chosen B. Very good. To say that ROC communication is mandatory, did we discuss anything about it? Not at all. Will this be a mandatory communication to them? Not at all. Something that will go to them in the form of financial statements will always be there. Correct? Yeah. So that's why, can we say that this option is correct? No. Because this also mandates taking this matter to the main report. So what are we left with? Option number D. And it's not that we are left with option number D, it's also something which will form part of the CARO report necessarily. May go to the main report, that depends on the assessment of the auditor, and the communication to those charged with governance is of course very, very important. Okay, yeah. So let me just come to your queries now. So Anjali is asking, sir, when we are required to communicate to other regulatory authorities, we need to report separately or audit report is sufficient? See, when it comes to other regulatory authorities, so we need to go by the regulation which will specify that. If the regulation will specify financial statements to be produced, then you will have to produce that. If that regulation will require any other form of communication, you will have to follow that. So for that, there are various legal requirements. I don't think we need to get into too much legal requirements around it. Okay. Harshan is asking, sir, we should verify cash by physical verification as cash is rupees 1 lakh. So this would have been done by the auditor. And that's why this may have got detected, or maybe the management would have detected. But yes, of course, to physically verify cash is an audit procedure and the auditor should have done. So we are not saying that the auditor didn't do this procedure. We were saying that there was a fraud which was detected. Okay. Sumit, okay, Sumit's query is clear. Anjali is asking, so if there is a situation that in a private company, a luxury car has been purchased by the company, but used by the family of the directors for personal purposes, and all the expenses of maintenance are borne by the company, does the auditor need to report it? Does the auditor need to report it? See, as around the reporting of these matters, again, you'll have to look at the regulatory requirements if that requires anywhere. I can just give you one example for this. It could be form number 3CD, that is in respect of tax audit. So companies which are subject to tax audit, they are required to comment on this. Very soon you will see this CARO 2020, which also talks about these aspects, which are more of propriety in nature. Yeah. In fact, the focus of CARO 2020 is around that only, but that is something not relevant for you as of now. But yes, practically you will see that getting implemented next year, hopefully. So there is some of these aspects will get covered. As around some of these expenses which are personal in nature and which are passed on to the company, those are inappropriate. And if those expenses of personal nature are getting booked in the name of the company, then it should not be done. Okay, appropriate adjustment should be made in the books of accounts, but at the same time, it's very, very important to understand as to what is the understanding, whether it forms part of the perquisites of the directors of the company. If that is the part of the perquisites of the directors of the company, then it's okay to do. Yeah, because this may be the part of the perquisites of the directors. Then it will not be considered to be a personal expense of the directors. It will be considered to be the benefit which is provided by the company and which is forming part of his appointment letter. Secondly, if the company has been maintaining proper records around all of these things which are provided by the company to the director, then it's fine. But if that is not maintained, then anybody can challenge, because this may be considered to be the personal expenses of the director, yeah, which may become very, very difficult to be handled. Okay, yeah. Sumit is asking, sir, if fraud amount is more than 1 crore, then it should be reported to central government. See, as I told you, that there are certain reporting implications around it, depending on the threshold of less than 1 crore and more than 1 crore. We are not just touching upon that point right now. We can just talk about it slightly later when we'll go to the requirements related to the Companies Act. Ambika is asking, sir, it can be included to other matter para in the main report. I think it should be included in the main report. See, it's not necessary. It's not necessary that this should go to main report always. As I told you, this will again depend on the assessment of the audit. Why? Because we are saying that even though these matters have occurred, but still they are not material. So again, we are not saying that this will never come. This may or may not come. This will depend on the assessment of the auditor. So we cannot say that because this has come or because this fraud has occurred, so that's why it has to be there in the main report. Yeah, that is something you have to take care always. All right. So now with this, we come to an end to our discussion on essay 240. Now what we can do is we can just move on to next auditing standard. Essay 402. Essay 402. We'll move on to this standard now. Just give me 1 minute. Then Sumit has a query, sir, materiality depends on which factor? See, on audit materiality, we have a separate auditing standard and we'll have a discussion around audit materialities separately. For the time being, I'll just touch upon this point, though we have talked about it briefly in the last session. There are various benchmarks which are available for determination of materiality. For example, materiality can be X percentage of profits of the company, or materiality can be Y percentage of revenues of the company, or materiality can be, let's suppose, Z percentage of net assets of the company. Now, what will form the basis of determination of materiality? Means, should this really be profit? Should this be assets? Or should this be something else? This will require an assessment of the business of the company, of how the numbers of the company have been moving over the period. Secondly, what should be the percentage of this benchmark which is chosen, whether this should really be say 1% of the profitability, or we can say 0.5% of the revenues. That is again dependent on the professional judgment of the auditor and the historical experience in relation to audit of the financial statements of that company by that auditor, which will be dependent on the adjustment entries in relation to the misstatements which the auditor may have faced in the past year. So there are various bases which are considered around it. On the basis of all of these factors, auditor determines the materiality. So I've just touched upon some of these points, Sumit. I have not gone into too much detail around determination of materiality, because as I told you, there is a separate auditing standard which provides us detailed guidance on this. And on the basis of that, we'll have to understand about the determination of materiality. Yeah, clear on this? Yes, so moving on to next auditing standard, SA 402. This is about service organization, or we can say audit considerations related to an entity using a service organization. Yeah. Now, in this case, there are few terms which we need to be familiar with so that we are able to understand the requirements of the standard and we are able to then apply them appropriately. So one is about the organization, or we can say first term will be about the understanding of the entity which is subject to audit. Number one. Second is about the understanding of the service organization, which is a separate organization other than the client, which is subject to audit. And third is about the audit firm or the auditor. So what we can do is we can just quickly take you to one flow chart or kind of, pictorial presentation around it so that you are able to appreciate some of these points. First, we have entity. Okay, entity or the company which is subject to audit. So we are looking at audit of entity. And let's suppose this entity has outsourced. This entity has outsourced some part of its process to another organization. Say payroll. Now this entity doesn't have this process in-house. Payroll is not maintained in-house. So this entire process of payroll is being managed by another organization, say ABC Limited. Let's suppose this is also a company. Now, what do we call this company as? Service organization. And what's the role of this company? To facilitate in respect of payroll or to provide services in relation to management of payroll, this company or this entity. And the third party is the auditor. Who would audit the financial statements of this entity? Who would audit the financial statements of this entity? Okay, now this is where this essay applies. So this should be the situation wherein the relevance of this essay will arise. So let's understand now what does this essay require and how would this essay be applied to any such organization. Now, because this entity is not managing the payroll, that's why when it comes to the audit of payroll, why? Because payroll will get recorded in the financial statements in the form of employee cost. So when it comes to the audit of payroll, will the entity have any details available with them? Yes, they may have. They may ask ABC to provide all of these details, which the auditor can check and verify. But in respect of various controls, various processes, or you can say various sub-processes, which this entity should have applied or which this entity would have wanted to apply to ensure that this process is operating in an effective manner. This is not becoming subject to errors. Who will have this responsibility? So this responsibility will be with ABC. Why? Because they are managing this complete process. All the records, all the vouchers, all the appointment letters of the employees, all the details around the employees, everything in relation to this is available with the home ABC. So all the records, etc., everything in relation to payroll is lying at the premises of ABC Limited. It's not at the premises of entity. Correct? Now let's suppose entity believes in strong internal controls. And this is what is demonstrated in respect of their other processes. All other processes of this entity have got strong internal controls which are operating effectively. So be it revenue, be it procurement, okay, be it capitalization, be it accrual. So I'm just naming some of the processes. All of these processes have been reviewed by the auditor. The controls around these processes have also been reviewed by the auditor, and the auditor found that all of these processes are operating effectively. Auditor found that all of these are operating effectively. Yeah. Then Sumit has a query. Sumit is asking, service organization means outsourcing of some operations of the entity? Yes, of course. Yeah, as we discussed. Manshu, I think you will have to check this. Now, next point is around these processes, or we can say this process which is available with ABC. Now, it may happen that the policies and procedures which entity has issued to ABC are not being followed by ABC in respect to payroll process. Or maybe that ABC is following its own policies and procedures to ensure that payroll function is operating in an effective manner. It can be either way. But how will the auditor get to know about it? When he will visit the premises of ABC and audit the payroll of entity, or I can just name this entity. Let's suppose this is PQR, and audit the payroll function of PQR to ensure whether this function is also operating in the same manner the way all of these functions were operating at the level of PQR. Correct? Yeah. For doing this, what would be required? There are a couple of things as we discussed. Either PQR can ask ABC to provide all the information, everything at the premises of PQR, which is practically not feasible. Yeah, practically it becomes very, very difficult. Or the other option is that auditor, instead of visiting the premises of PQR, may visit the premises of ABC and audit payroll as if he is auditing the payroll sitting at the premises of PQR. And this, of course, be done on the basis of joint discussions. First of all, this communication should be made by PQR to ABC that such and such audit will take place, such is the time. And after that, proper coordination, this audit will have to start. But this mechanism has to be done in a way that this audit is done for PQR sitting at the location of ABC, wherein the personnel of ABC will get this audit done. They will provide all the information, they will provide all the explanations. Everything which would have been done by PQR will now be done by ABC. Okay, clear? Now let's see what can be the audit procedures around it and how should this really be dealt with by the auditor other than this visit by the auditor. Now, similar to any other audit, the auditor would first of all like to have an understanding of this process. Means, how is this process managed? How is this process managed by ABC? What are the risks and what are the mitigating controls by ABC in respect of such type of risks? And these risks and controls are all limited to the payroll function only. So auditor will not go beyond payroll because that's the only information which is available with ABC. Correct? Next, auditor will also perform his testing of controls. Means if he wants, he can pick up sample of some of these items the way it was done over there. So he will also perform testing of controls sitting at the premises of ABC, and wherein ABC would be coordinating for all of this. Clear? Yeah. Next, various other information related to payroll which may be required to be audited by the auditor. Maybe if he wants to perform any analytical procedures, maybe if he wants to do substantive testing by looking at various details let's suppose for PF, for ESI, let's suppose for salary rationalization, let's suppose for increase in the number of employees, let's suppose for rationalization around the head count and the average salaries of the employees. All of these details will be audited by the auditor, and all of these procedures, be it control testing, be it analytical procedures, or be it any other substantive audit procedure, will be performed by the auditor along with ABC. Correct? Now, once the audit is completed or during the course of the audit, all the queries, all the observations which the auditor will have discussions around all of these points with team of ABC. So because he will have his queries, so any sort of observations, etc. First of all, auditor should discuss with whom? ABC. So it should not happen that, let's suppose, auditor is checking some data and auditor has found some mistakes. See, those may not be the mistakes, but auditor thought those to be the mistakes. Auditor had some observations around it. Auditor didn't discuss those observations with the team of ABC. Instead, auditor took all of these matters to PQR. Will that be appropriate? The answer is no. That will not be appropriate. Why? Because it's ABC who has got this complete visibility firsthand. So that's why it will be best to discuss all of these points with ABC first of all, before taking all of these matters to PQR. Yes, of course, there's no doubt that all of these observations, even after these are discussed with the team of ABC, auditor would want to discuss those matters with the team of PQR also. Because ultimately, in respect of this function, who is responsible? It's PQR who is responsible. Because who has got the financial statements? Financial statements are of PQR, not of ABC. So that means by passing on this process to ABC, PQR cannot say that because this part is outsourced, so that's why it will not remain the responsibility of PQR anymore. Okay, clear? This process, because this forms part of financial statements of PQR, would become the or would remain the responsibility of PQR only. Let's suppose if there is any material misstatement, auditor found material misstatement. Auditor found material misstatement during the course of his audit in relation to payroll function. And auditor discussed about that misstatement with ABC, and ABC said that this is a misstatement and this is material, but this is dependent on the information that I received from PQR, because ultimately who maintains the master data? The master data means the information around the employees as to who are the employees of the company, who are joining, who are leaving. First of all, it's the record which is with the company only. Yes or no? Its management is with ABC, but if any employee has to join, where will this employee join from? PQR. If the employee has to leave, where will that employee leave from? PQR. Yeah. So if this information is not made available to ABC properly by PQR, and if any material misstatement arises, who would then be responsible for this? Of course, PQR. So let's suppose there's a material misstatement which the auditor has identified, and the auditor reaches out to ABC, and ABC says that this is because of the improper data that we received. That's why we have this material misstatement, and that's why auditor moves this matter to PQR. Yeah. So in such a case, what should be the course of action? In such a case, adjustment entry should be passed by PQR in its financial statements in respect of this misstatement. If that is actually a misstatement, then that is material. If that is not done, then what will happen? This will have a reporting implication. This will have a reporting implication by the auditor. In this case, PQR will not be able to say that this is a part I have outsourced. So if they have made a mistake, we will not accept this adjustment entry. No. Clear on this? Yeah. There is another type of situation which is possible over here. And in the meantime, I have this query coming from Ambika. Ambika is saying, sir, is it necessary to visit ABC or access the data through software, or if we can access this data through software application will be sufficient? See, that depends on a case-to-case basis. It is not necessary that the auditor would want to visit the premises, though it's always better to at least visit once, so that the auditor will have some understanding. But till the time you will not visit the location, you will not be able to understand everything. But still, if we believe as an auditor that just by getting the data completely will be able to get into a comfortable situation in respect of sufficient appropriate audit evidence which is required to be obtained, then there is absolutely no problem. So it's not a mandate to visit the office. Okay. Secondly, standard also talks about certain reports which are called as type 1 or type 2 report, which can be made available by this organization in respect of this function of PQR. And this report is all about the internal controls around the function as to how those controls have been implemented, how those controls have been operating, whether those have been operating effectively or not. At times, the auditor may also want to place reliance on those reports in respect of his audit procedure, and in which case, auditor may not want to get into too much details around the audit procedure. But that depends on a case-to-case basis. That depends on the comfort of the auditor as to whether he just wants to go by that report or wants to perform additional procedures like these, maybe all of these additional procedures or only some of those audit procedures. Okay, clear? Then Himanshu is asking, can we apply direct confirmation? See, in this case, applying the direct confirmation can be a part of the procedure as we have just discussed, which is again not a problem. So if we don't plan to visit the premises and we want to apply the direct confirmation, we can do that. But please try to understand that direct confirmation is in respect of the balances. Okay. I think you're just trying to use this term direct confirmation, but direct confirmation will not really work here because it's the P&L information. It's the information of expense. It's not a balance which is required to be confirmed by ABC. So let's suppose if you roll out a balance confirmation to ABC, or if you send a confirmation to ABC, what would that confirmation require? Would you want ABC to confirm the number of employees? Would you want ABC to confirm the total amount? What is it that you would require out of him? And anyways, ABC is nothing but a part of this entity in a way. So this type of procedure will not really be relevant. But yes, if there is any specific item in relation to sending a direct letter to them for anything, that can always be done. And that will again be dependent on a case-to-case basis. Okay. Yeah, another type of situation which is possible in such type of scenarios could be the one wherein PQR has not outsourced complete payroll to ABC. Okay. Maybe the accounting of payroll is done by PQR only, and some part of the payroll information is maintained by PQR only. But some of the things, say for example, PF computation, ESI computation, generation of salary slips, computation of income tax, etc., on the employees' data. Yeah. So some of these activities related to payroll may have been outsourced by PQR to ABC. So at times, this type of situation is also possible. So whenever we will have this type of situation, what do we do as an auditor? Therein again, we will have to follow the same audit procedures. First, to understand about the process. Means what type of, what part of process is with ABC and what part of process is with, PQR and what part of process is with ABC. Secondly, in respect of the processes which are available in-house, auditor can always do that audit sitting at the premises of PQR. But in respect of the part which is available with ABC, that depends again on the judgment of the auditor, whether he would like to get this information from ABC and whether he would want to visit the premises of ABC or whether he would want to rely on that report from the ABC in respect of his audit procedures. Yeah. So this is again varied. This again depends on a case-to-case basis, and at times you will get to see both these type of situations. There are certain entities which outsource some part of their payroll process outside the organization. This is again very, very commonly done. And there are many entities which also outsource complete payroll activity. Okay, yeah. So that's why it's again on the judgment of the auditor, and this may also have a factor wherein the past experiences of the auditor may be used. So maybe in the last years, auditor found a lot of mistakes in respect of the payroll process, because of which he doesn't have too much comfort around it, and that's why he may want to perform these audit procedures rather than just looking at that report. Yeah, clear? So some of these things become important on the part of the auditor. And as around the audit procedures, all of those factors will have to be considered. Planning will have to be done. Planning will involve the risk assessment including the assessment of fraud over here. And once the planning is completed, then the execution of various audit procedures, be it control testing, be it analytical procedures, substantive, all of that stuff will continue to flow over here as well. Okay. Clear? Yeah. So this was a very, very small auditing standard, and there was nothing beyond this actually, because as on the audit procedures, everything largely remains same except this different type of scenario which arises under this auditing standard. So if you have any questions around it, please let me know. They're done on this auditing standard. And before we move on to the next auditing standard, we can just, sort of have a discussion on your queries. Yes, quickly. Any questions in case you have on this, please let me know. We will now move on to next auditing standard, SA 450. Evaluation of misstatements identified during the audit. Okay, so now for this auditing standard, I understand that the time is very limited and will not be able to complete this auditing standard. But we'll start with some part of this auditing standard, particularly in terms of some of the definitions, etc., and the meanings, etc. There are two things which are very important for us to understand before we get on to this standard. First is misstatement and second is materiality. We have already talked about materiality quite a lot. Yeah, materiality is already something we have discussed. I'll touch upon that once again. But before materiality, let's try to understand the meaning of misstatement once again. Okay. What is a misstatement? Misstatement means an error. And we discussed about misstatement. It could be intentional or unintentional. Intentional is something which we are considering to be an error. Unintentional is something which we are considering to be an error. And intentional is something which we are calling to be a fraud. Now, what is a misstatement? A difference between amount, classification, presentation, or disclosure of a reported financial statement item and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with applicable financial reporting framework. Misstatements can arise from fraud or errors. When the auditor expresses an opinion on whether financial statements give a true and fair view or not in all material respects. Now, this is important. True and fair view in all material respects. So you can just note it down, please. In all material respects. Misstatements also include those adjustments of amounts, classification, presentation, disclosure that in auditor's judgment are necessary for the financial statements to give a true and fair view in all material respects. Next is uncorrected misstatements. That means misstatements that occur and which have been accumulated by the auditor and which have not been corrected by the management in the financial statements. And third term is materiality. So let's understand about all these three terms. So we have used the term materiality. Now, in case of a financial statement, let's suppose if there is an error. Of rupees 10 lakhs. And let's suppose materiality is rupees 5 lakhs. Materiality is rupees 5 lakhs. In this case, error is crossing the materiality threshold. That means error is material. That's why this type of error cannot be ignored. Why? Because this will lead to material misstatement. Or in other words, we can say, auditor will not be able to comment, auditor will not be able to express his opinion on true and fair view in all material respects. Okay. Let's suppose there is an error, but that error is of rupees 2 lakhs. Now error is big enough, but that is below materiality threshold. Okay, and now this error is also unadjusted in the financial statements. Now in this case, let's think about the auditor who has to express opinion on truth and fairness in all material respects. So can the auditor continue to do that? Means express his true opinion on truth and fairness in all material respects, even though this error is sitting in the financial statements? The answer is yes. Why? Because this error is not material. This error is less than materiality. Correct? This error is less than materiality. Yeah. Now, standard says whenever we have got misstatements, we need to bifurcate the misstatements into two categories. Always. Let's see how. All the misstatements whether that is fraud or error, those should be bifurcated into two categories. Material and which are not material. If the misstatement is material, yeah, then this will have reporting implications on the part of the auditor. Then this will have reporting implications. However, if the misstatements are not material, then the auditor will have to check the sum total of those misstatements. Or you can say there could be various misstatements in relation to revenue. There could be various misstatements in relation to PPE, and there could be various misstatements in relation to, say, we can pick up another head, say inventory. Okay, yeah. When we add the misstatements related to inventory, those are not crossing the materiality threshold. Those are not material. So those are less than materiality. But if we add the misstatements, means if we add the errors, various errors which have occurred in case of PPE, then those errors cross the materiality threshold. And if we add the errors in case of revenue, those are again less than the materiality threshold. Okay, yeah, clear? Now, because PPE as a head, PPE as an account head, PPE is as an item in the financial statements, even though has got multiple errors of small amounts, but still at the caption level, it is misstated. And this misstatement is also material. That's why this will have once again reporting implications. So that means We don't need to go by the error if that is crossing the materiality threshold on a standalone basis or an individual basis. No. Even if there are multiple errors in relation to a particular account head, we need to check whether it's only one error or there are various errors which may be of small amount. When it comes to misstatement and when it comes to assessment of material misstatement, we need to take the total of all of these material misstatements or total of all of these misstatements to assess whether there would be any reporting implications or not. Clear? But in case there are misstatements, but those are not material, then of course the reporting implication will not arise. What will be required? We'll have to have a discussion around it separately later on. May not be today, in the next session. As of now, a question may come to your mind. So what is this reporting implication? Reporting implication means auditor will have to check whether he needs to report this in the audit report or not. Why? Because if the management agrees that this material misstatement will be corrected in the financial statements, then it will no longer remain a misstatement, and that's why it will not be required to be taken to the auditor's report. But if the management refuses, then of course it will have to be brought into the auditor's report. Clear? Yeah. So these are only some of the terms that we have discussed today. I am not getting into too much details around it. In the next session, we'll have to take it up. Now I'll come to the query of Sumit. Sumit is saying, sir, if sum total, it's not sum, it's sum total. Sum means total. You can just ignore sum. Say total of errors. Total of various errors. He's saying if the total is more than 5 lakhs of various immaterial misstatements, then will they be reported? Of course, yes, as we have discussed. They will be reported if those if they are not corrected in the financial statements. If they get corrected in the financial statements, then they will not be reported. Yeah. So it all depends on whether the correction is done in the financial statements or not. Clear on this? Yeah, all of you? So with this, we come to an end to our discussion. With this, we come to an end to our discussion on this auditing standard. We are not yet done on SA 450. We'll have to continue with this SA 450 in our next session. In the meantime, I would just again request all of you to just make sure that you revise these auditing standards. And when we meet next, we can just pick up this SA 450 to start with, and then we'll pick up more auditing standards. Okay, yeah. Thanks to all of you once again for your wonderful time and participation. Yeah.